Hello, property navigators. In this video, we're going to break down using trusts for property investment, covering everything from how they work, who's involved, to the tax, asset, and estate planning benefits Aussie investors should know about. This video comes thanks to @Flabby6329 for asking about this on our channel. Today, we're covering it in full detail. It's a huge topic and we have a ton to get through, so let's get going. Hold on, just remember, I'm not allowed to give you personal and financial advice, so make sure you see a specialist legal and accounting pro to get personal advice on what might be right for you. So now you can't sue me, let's get into it. What are trusts? Important to note here straight off the bat that trusts are not specifically for property. A trust allows a person or company to own assets on behalf of someone else or on behalf of a group of people. At its most basic level, trusts separate legal ownership of assets from beneficial ownership. Put simply, a trust is a structure which exists where person A holds assets, be that shares, property, or any other income producing assets such as businesses, for the benefit of person B. Person A is known as the trustee and is the legal owner of the property which is held on trust for person B, who is known as the beneficiary of the trust because they will benefit from those assets in the trust. The trustee can be a person, a group of people, or a company. There can be more than one trustee and there can be more than one beneficiary. The trustee may also be a beneficiary of the trust, but they can't be the sole beneficiary unless there is more than one trustee. Where there is only one beneficiary, the trustee and beneficiary must be different if the trust is to be valid. The trustee is the legal, formal, registered owner of the assets in the trust. The beneficiaries are known as the beneficial owners and have the right to receive the benefit of trust assets, whether that is through the income they generate or the capital they create, or both. When a trust is established and property and assets are accumulated within it, over time, the trust ends up owning a bunch of these assets that grow in value, which over time will produce an income. And ultimately, it gets distributed to all of its beneficiaries. Trustees have what is known as a fiduciary duty towards the trust's beneficiaries. This means that while the trustee is the legal owner of the relevant assets within the trustee has an obligation that those assets must be used only for the advantage of the beneficiaries, which limits decision-making that could benefit others outside of the trust structure. The courts very strictly enforce the nature of the trustee's obligations to the beneficiaries in regard to this. In contrast to individuals and companies who by law can be sued and can sue, a trust is not considered an entity in its own right. The trust exists merely as a relationship between the legal owner, being the trustee, and the beneficial owners as the beneficiaries. So how does a trust work? Trusts are set up with the help of a professional. The rules of the trust are laid out in a document called the trust deed. A trust deed is a legal document that sets out all the conditions, terms, and rules for creating and managing the trust. Things like if, how and when the deed can be amended, what the trustee can do, and who the beneficiaries are, along with many other formalizations. The parties involved will typically be the settlor. This is the person who establishes the trust, often a lawyer or accountant. They settle an amount on the trust and set up the terms of the trust through the trust deed. The settlor cannot be a beneficiary of the trust. The settlor may have an ongoing role which would be set out in the trust deed. Commonly though, the settlor generally is not involved in the operation of the trust, and once the trust is established, the settlor's role is complete. We have the trustee. This person, people, or company is in control of the trust and makes the decisions. Trustees are personally liable for the debts of the trust, as the trust assets and liabilities are legally those of the trustee. If there are liabilities that could arise, it is common to use a limited liability company structure as the trustee. This can clearly distinguish the trust property from that of the individuals who control the trust, and it's a neat way to provide optionality into the future because you can change company directors or add new directors, so you have the flexibility to control the trust in different ways. We have the beneficiaries. Now, these are the parties that can benefit under the trust, most commonly through the distribution of income or capital from the trust's assets. Often the trust deed will name a small number of specific individuals, such as the primary beneficiaries. The rest of the secondary or potential beneficiaries are not specifically named in the trust. They tend to be defined by reference to their relationship with the primary beneficiaries. For example, the children of XYZ, or grandchildren of, or a company controlled by. The trustee will often have the ability to add additional beneficiaries, with the rules for doing so set out in the trust deed. A beneficiary also can disclaim their interest in the trust and cease to be a beneficiary for a particular year or permanently. Now, lastly, some trust deeds list an appointer or principal role. This is a person who has the power to appoint, remove, or replace the trustee. For that reason, they are seen as the real controller of the trust, but not all trust deeds include this role. A trust must vest, which means to be wound up, and its assets distributed to the beneficiaries within 80 years of being set up, except in South Australia where there is no time limit to a trust. Why buy property in a trust? As I'll explain, the main benefits of buying property in a trust relate to asset protection, taxation flexibility, borrowing power protection, and estate planning. Asset protection. An investment property owned by a trust is held in the trustee's name, not in the beneficiary's. This means in many cases the trust's assets are protected from creditors if one of the beneficiaries goes bankrupt or is subject to legal action. This clear separation of legal and beneficial ownership can create a high level of asset protection because the trust property is distinct from the personally owned property. However, trusts are often set up with an individual person as the trustee, which effectively neutralizes a major component of asset protection. This is why a company structure is used as the trustee in many cases. Tax flexibility and benefits. From a taxation perspective, provided a trust is properly run, trust income is generally taxed in the hands of the beneficiaries. So tax payable is spread across multiple people. Now, I'm going to be getting right down into the calculations, crunching real numbers to show examples of the tax benefits that a trust can provide and how it's done in just a moment, so stay tuned. Where the trust conducts a business enterprise, it can register for both an ABN and GST. Trusts have their own tax file number and are required to lodge tax returns annually. Depending on the type of trust an investment property is held in, the 50% capital gains discount can be taken advantage of if owned for over 12 months. Borrowing power and protection. When you buy within a trust, the trust gets the loan and holds the asset. Once the trust trades profitably, meaning rental income covers loan repayments and the running costs, you can essentially sequester that debt from your personal portfolio. This process, often called ring fencing the debt, ensures that it doesn't sit on your personal liabilities anymore, and therefore that debt isn't taken into consideration when applying for finance in your own name. Estate planning. On the estate planning front, a trust can be a way of limiting an estate's exposure to challenge by disgruntled beneficiaries, or can even be created as part of the estate plan to provide an even higher level of asset protection and flexibility. Each trust deed must outline what will happen upon the death of the trustee. A new trustee may be appointed, or the deed may outline what will happen to each beneficiary's share of the trust's assets. This simplifies the estate planning process and can help avoid any messy legal battles within families. Different types of trusts. As you can see on screen, there are a ton of different types of trusts, and each have their own purpose and benefits. While I'd love to run you through each type of trust and their intricacies, I'm keeping this video specific to the main trusts used to hold property here in Australia. I must point out here that superannuation funds, whether industry super funds or a self-managed super fund, are also types of property owning trusts. But I'm leaving super fund info completely out of today's conversation because it is such a detailed topic that we have a whole video dedicated to SMSF structures, and the link is just down in the description. Now, the three main types of trusts which are used for holding property are discretionary trusts, which can also be known as family trusts, unit trusts, and also a special type of trust that are a combination of both called hybrid trusts. Discretionary trusts. These are often called family trusts because they are usually associated with a specific family group. There are more than 600,000 discretionary family trusts in use around Australia, and despite misconceptions about them being used as tax avoidance schemes by fat cats, they are very commonly used by mum and dad investors, rural and farming owners, and small to medium enterprises. Discretionary trusts can access a range of capital gains tax concessions, including the 50% CGT discount. In a discretionary trust, the trustee has a discretion of where to apply the income and/or capital, so they decide who will receive what and how much of it. The trustee has greater control and flexibility over the disposition of assets and income, since the nature of the beneficiary's interest is that they only have a right to be considered by the trustee in the exercise of his or her discretion. This allows the trustee to split that income between beneficiaries in the most tax-effective way each year, because the income distributed to each beneficiary makes up part of their personal income, meaning they pay tax on the income based on their marginal tax rate. If the beneficiaries are on different marginal tax rates, the trustee can decide, and usually on the advice of their accountant, where to split the profits to produce the least amount of tax payable. A trustee may choose not to distribute income to a beneficiary who is already paying tax at a high marginal rate in favour of a beneficiary who has a lower or minimal tax rate. For example, let's say a family trust has 5 beneficiaries that is made up of 2 parents, one retired making $0 per year and one who makes a salary of $195,000 per year, meaning that their marginal tax rate is 45%. Their 3 adult children also are beneficiaries, 2 of which are stay-at-home parents without income, and the 3rd child makes $100K per year and is therefore on a 30% marginal rate. Each adult has an $18,200 tax-free threshold, where any income under that threshold is tax-free. If the trust's income is $60,000 for the year, the trustee can decide to make $20,000 distributions to 3 beneficiaries that don't work, taking advantage of their tax-free thresholds, meaning the tax payable on each of the $20,000 distributions is $342. So total tax on that is $1,026. Compare this to if each of the 5 beneficiaries were to receive an even amount of $12,000 each. Because of the varying tax rates across the family, the tax payable on that $60,000 would be $9,840 instead of $1,026. Now, this is a very basic example using small numbers, but it serves to illustrate how this could lead to higher returns over the long term, because you get to keep more of the money generated from the trust. Especially so if we were to multiply these income, distribution, and beneficiary figures by 10, and then multiply these taxation savings over the course of a trust's 80-year service life. A multi-generational family could save millions on tax payable and use that additional income to set up family wealth for life. A trustee could theoretically decide not to distribute any income or capital to a beneficiary, but the trust would then be liable to pay tax from its own profits, so this isn't generally that common. Next up, we have unit trusts. Unit trusts provide a clear and defined ownership structure that is fixed based on the units that are held, making them suitable for joint ventures and partnerships. Beneficiaries and their respective interests are identified by their holding of units, much in the same way as shares are issued to shareholders of a company. The beneficiaries are usually called unit holders, and it is possible to have different types of units with different rights attached that outline each beneficiary's share of income, losses, and capital gains. For example, if there were 5 beneficiaries and each were equal 20% unit holders, if that trust was to distribute $60,000 of profits, then each beneficiary would receive their fixed 20% share equaling $12,000 each. Beneficiaries can transfer their interests in the trust by selling their units to another buyer. Now, lastly, we're going to cover hybrid trusts. A hybrid trust, for simplicity's sake, is essentially a combination of a discretionary trust and a unit trust, and has the benefits of both. In most hybrid trusts, a beneficiary's entitlement to capital is proportional to the number of units they hold, while the trustee also has a discretion in relation to the distribution of income from the trust. And discretionary income beneficiaries can be different to the fixed capital beneficiaries. The fixed entitlements to capital or income are dealt with via special units, which the trustee has the power to issue. Hybrid trusts provide the distribution security of a unit trust for beneficiaries, while allowing flexibility for the trustee to use financial discretion on distributions outside of those unit holders' rights. How to transfer assets into a family trust. Suppose you've set up a family trust for your family's future investments. If that's the case, you can simply go ahead and use the trust as a vehicle to purchase your next investment. However, how do you go about transferring existing assets, such as property, into your new family trust? Well, you do this by transferring the title of the property to the trust. By transferring your individually owned property title, this essentially means that you're transferring the interest in that property to the trustee, which could be you or whoever else the trust deed states. The trustee will become the new legal owner of those assets. You can transfer the property title to the trust by either selling the property to the trust or gifting it to the trust. Both may have capital gains tax and stamp duty implications, which I'll explain. The first option you can choose when transferring the property title is to gift it to the trustee. The trustee and the trust will have to sign a gift deed, which establishes that the ownership of the property is being transferred without payment. If you still have an outstanding loan on the property and the loan is being transferred to the family trust, the trustee will have to undergo the loan approval process, so you need to engage a mortgage broker and solicitor or conveyancer. The second option is selling the property to the trust. This process would be the same as the buyer and seller entering a contract of sale. You would be the seller and the trustee would be the buyer. You can either sell the property at market value or below market value. In other words, you could choose to make a profit from the sale of the property by selling it at market value, or you could sell it to the trust at a price, say, enough to pay off the existing mortgage. When transferring property to a family trust, it is important to bear in mind that there may be capital gains tax and stamp duty implications. Capital gains tax. Whether the property is gifted or sold, the title transfer will still trigger capital gains tax. Depending on your circumstances, you may be eligible for the capital gains tax discount. For example, your main residential property is usually exempt from tax when making a capital gain on its sale. And if you held an investment property for 12 months or more before transferring it to the trust, you may qualify for a 50% discount on capital gains tax. Stamp duty obligations. Stamp duty is a government-levied tax that the buyer has to pay on the transfer of property. Each state and territory determines their own stamp duty rates. As with capital gains tax, you may be exempt from paying stamp duty depending on the state or territory's property threshold, whether you're a first-time buyer or not, and if the property is a main residence. Land tax threshold. Well, you just like, what the f is land tax? Well, if so, I'll very briefly explain. When buying property, some states have a threshold for which the value of the land you own can be up to before land tax is payable, and anything under that value means being exempt from paying land tax. For example, in New South Wales, the land tax-free threshold is $600,000. This means that you can buy property under your own name that has land values up to $600K without paying additional taxes on the value of your land up to that amount. And note here I'm saying land values, not property values. I believe this is based on the value of the land found on your rates notice. However, in New South Wales, property that is owned within a trust does not qualify for this, and land tax must be paid from the first dollar of land value. It doesn't sound like a lot when you're paying $1,000 or $2,000 or $3,000 per year, but if you've got a property portfolio that's all in the same state, it can start to really add up. It's an unnecessary tax that you end up having to pay that can lead to large tax bills that lead to a lot amount of money over the lifetime of the investments. So before setting up a trust and bearing the cost of transferring your assets into that trust, you should figure out whether a family trust is a suitable option for you, especially when it comes to land tax. On the other hand, if you already own property in your name and are paying high land taxes, it may be beneficial to consider a trust structure for your next property purchase. Costs, disadvantages, and things to be wary about. Anyone considering setting up a trust needs to think about why it is being used and how it will be used, because many people will never need to structure themselves in this way. They are not a magic bullet solution. A trust structure can be costly to start up and maintain. You'll have to consider whether the benefits exceed the costs. For example, if you set up a trust that utilizes separate companies or entities as beneficiaries or trustees, each will be required to lodge separate tax returns every year, which increases accounting fees. Additionally, startup costs are anywhere from $1,500 to $3,000, and yearly maintenance costs are about the same. So you'll need to do a cost-benefit analysis. you'd probably be looking at a minimum 5-year timeline to build your trust's investment portfolio. Because if you're not investing for more than 5 years, it's a waste of time. It's a waste of money. Unless you've got a surefire investment plan with 2 or 3 properties with $500,000 worth of capital gains each, and you've got other entities that you could distribute the capital gains towards, then yes, it's absolutely worthwhile. Another disadvantage is that while you can distribute income under a trust, you can't distribute losses like depreciation or apply negative gearing. These tax deductions only get carried forward for the future profits within the trust, whereas they can sometimes be more advantageous in your own name, so you can deduct the loss from your assessable income, resulting in reduced personal taxable income. What this simply means is you don't get the tax benefits right away. Other common issues arising from the improper use of trust structures include the failure to make and properly minute distributions within the ATO's set timelines, which can result in paying tax at the highest marginal rate. The failure to properly deal with succession planning of the appointer role, the failure to appropriately deal with loan accounts and unpaid present entitlements, improperly amending trust deeds resulting in duty and capital gains tax implications, poorly drafted definitions of beneficiaries which can result in the trust being deemed to be a foreign trust for duty and land tax purposes. There is also the ongoing possibility of legislative change to the taxation treatment of trusts. What happens on a trust's vesting date? When a trust vests, i.e. it is wound up, the beneficiaries become entitled to all of its assets and income. The trustee must distribute all assets and income to them in line with the trust deed. A trust deed will usually have a set of rules the trustee must follow when doing this. And there we have it, a full rundown. If you want to find the right property that does its job for your trust by performing well so your beneficiaries attain good distributions well into the future, then pick up the phone and call us or jump onto our website and book a discovery call. We do this all the time. Until next time, happy property navigating.